Well, hello everyone, and welcome to TradeStation's educational webinar series. Today we want to help you become better traders, and we've enlisted Greg Jensen, the founder and the CEO of OptionsANIMal, to help us with a problem. Many experts believe that the most important thing a new trader can do is become educated about the language of trading and the basic market concepts. Using both technical and fundamental analysis helps traders focus on key pricing analysis studies and assist in the determination of the basic condition of a company or an underlying security by examining the core factors. Today we're going to talk about advanced option techniques and how to repair losing trades. Our presenter, Mr. Greg Jensen, is the founder and the CEO of OptionsANIMal. He is an option investor, a speaker, and an author, and his book, Spread Trading, An Introduction to Trading Options in 9 Simple Steps, like his cutting-edge and innovative education, focuses on giving investors the tools and the knowledge to put the odds of success in their favor. Now, our presentation today is for educational purposes only. All the symbols and trading ideas that we discuss here are for demonstration purposes. They are not recommendations. Our presentation is not an offer or a solicitation of any kind in a jurisdiction where any TradeStation affiliate is not authorized to do business. Active trading is not suitable for everyone, and options trading carries a high degree of risk and may not be suitable for every trader. In the chat panel, I have posted 2 disclosure PDF documents that will spell out some of the characteristics and risks of the various tools. Certainly, we have a link to the characteristics and risks of standardized options written by the OCC. Now, you can download those from here or take a look at them on the TradeStation website. Now, our presentation today is being recorded. It will be available on the TradeStation website at the video station, in our video station tool. If you're a TradeStation user, if you're not, you can go to the TradeStation YouTube store or YouTube page and review all of our webinars there. We'll answer questions at the end. I see some coming in already. So we will turn things over to Greg Jensen right now and get started learning how to make these kinds of adjustments that will help us make more money. Right, Greg?
Don, thank you. It's a pleasure to be here. And since you already gave the disclaimer of, we're not giving you investment advice, here's my advice for you then today. Just sell everything and buy Bitcoin, right? Of course not, right? I thought it interesting that the definition of a bubble right now, I think, is Bitcoin. But I'm not here to talk about bubbles or Bitcoin. I'm here to talk about options and specifically how I use them to fix broken trades. So let me talk first of all about an example of a trade that may go the wrong way. So here is a past trade of mine, and I will just, let me walk you through the thought process that I was looking at. So here's a company, VMware. They had just announced some very solid earnings. They beat expectations. They raised guidance. And if I'm looking at, as I was looking at this trade here, I thought to myself, okay, here's a stock that's got some pretty decent support level. Maybe my animation is going to work. There we go. I've got a pretty decent support level that was a former resistance. It then backfilled a little bit and filled on this support here. It then started to rally off of that and had good earnings. So my thoughts are, could I structure a trade that could allow me to take advantage of it? Now, I'm not going to go into the details of how to structure this bull put spread, but essentially, when I structured this trade, I had a 60-day trade that, as long as VMware stayed above this dotted line, and it can be anywhere above. It could be, trading up here at 110. It can be trading down here at 90. It doesn't matter where it's trading at, just as long as it's above this level here. And again, I've got about a $10 cushion from where the stock is currently trading and where I'm going to structure this trade. So that's how I structured this bull put. And then, of course, once I put the trade on, like it seems to always happen to us, right? The floor fell out from underneath it. Now, what most people are experience here is they experience a loss, whether it's fear that panics them out of the trade, maybe fear freezes them in the trade and they don't do anything to it and they experience their max loss. Hopefully that's not the case. But what most people experience, if they're following some type of discipline, is they have a stop loss here. Now, a stop loss is better than nothing. I will say that. But here's the problem with stop losses. There's only one thing a stop loss actually guarantees me. The only thing it guarantees me is a loss. It does not guarantee a fill price. It does not guarantee that I'm only going to lose 10% because stops can be blown right through. Now, in this case, it wouldn't have. It actually slid through. But that's the only thing a stop does for me, is it guarantees I'm going to lose. What I like to do is take the viewpoint, well, what if I tweaked the trade? And instead of accepting a stop loss, what if I simply just recognize that a trend change just happened with this position and I need to adjust or morph with this trade? And that's what I did. And instead of losing money on the position, with this new down trend, I adjusted the trade and was able to close the trade for a 5% profit in a 15-day period. Now I'm going to walk through how I did this later on in the class, the actual details of this step-by-step process. Let me introduce myself a little bit for those of you who don't know who I am. Don did a good job of introducing me. My background is I'm a trader. I started trading while I was in college. I'm not a floor trader. I didn't learn how to trade down in the pits or down in New York on the floor. I'm not a broker. I do manage a hedge fund, and I'm not looking for money for new advisors, but I do professionally manage money now. But my real background is I'm a trader just like you. I learned how to trade from my home computer. I grew up on a farm in Idaho. My first exposure to the markets were watching my father use the futures prices of his wheat that he would grow to hedge his crops. He then called me up one day and said, hey, while I was in college, and he said, hey, we had a pretty good year on the farm this year. I'm thinking about putting some money into the stock market. Do you want to help me? And of course, my answer to him was, well, do I get a cut? And so, yeah, of course I helped him. And then I fell in love with the market, changed my major, got my degree in finance, and then went on to trade for a living for several years. Now, I was then approached by several individuals to teach them. Well, how are you doing this? Can you teach me? So I created OptionsANIMAL with the intent of teaching people how to use options to trade in the market, to preserve wealth, and more importantly, to use the options instruments to trade any market that is given to you. You know, to be bluntly honest right now, folks, most of you have probably had a fantastic couple of years trading, especially since the elections, right? My guess is over the last 6 or 7 years, you've seen your accounts go up in value because most of you, and I say this kindly because I know some of you are great traders and understand the risks that you're in. Some of you are relatively new to this and don't understand what a bear market feels like. But most of you are mistaking a bull market for brains right now. Now, again, I say that kindly because I did that same thing back in the 90s. My first exposure to the markets, as far as timing wise, it was the 90s. It was the early to mid 90s. I went through a fantastic bullish decade of the 90s where the markets pretty much went straight up. We had a few little hiccups, here and there. Long-term capital management scared the markets for a little bit in 97 and 98, the Russian ruble crisis in 98. But for the most part, we just focused on, do you know what? The internet's changing things. And the tech stocks went through the roof and valuations were thrown out. And nobody cared because, hey, it's the new norm. And then the painful correction of the internet bubble came along and taught me a very expensive lesson. And what I don't want you all to do right now is repeat what many of us in the past have done who have been in the trading world and mistake that bullish market for brains right now. Hopefully you've made money. Hopefully now what you're figuring out is how to use option strategies to protect that money and hedge that money as time goes forward. Let me talk specifically one of my favorite strategies, and I'll walk through the adjustments on this as well. We talked to you about the collar trade real briefly for those of you who like to trade equities, and then I'll get to the bull put again for those of you who are straight option traders. And then I'll tell you a little bit more about OptionsANIMal and how you can find out more information about us later on. Collar trade. This is the core. If you have stock, you need to understand this strategy. Now, some of you may say, well, I don't like stock. I personally still believe equities are one of the biggest, best places to build and store wealth long term, to just buy and hold them. Yes, I know I said that word, buy and hold. A lot of people hate the word buy and hold. Doesn't mean I don't know how to hedge them when I need to, and I don't know how to use covered calls or protective puts at time for time, and that's what those two optioned instruments are with me. But in my opinion, one of the best ways to build wealth long term is to be able to find a company, whether it's a company like Amazon or Apple or Disney, which obviously those guys are all in the latter end of their big bullish runs, right? I don't know, maybe you can make an argument that Amazon's not. I will, from a valuation standpoint, that it's a little bit out there right now. But what the collar trade allows me to do is invest in those ideas and then use the options instruments to hedge that risk. So again, the collar trade is the combination of these three instruments: the long equity position, the long put position, and the short call position. Now, although in theory, I present this trade, all three instruments at the same time, very rarely will I ever have them on all at the same time. And I'll go over those rules here in just a little bit as far as the adjustment side goes. But really the reason why I use this trade is it allows me to approach the market regardless of the potential trend. If I feel like we're at a market top and it feels like things are really overinflated, but they may keep getting more inflated, well, the collar trade is the perfect strategy to use. I know those people who have tried to jump the bearish market over the last 6 months and say, okay, well, we're finally at a top. The Trump bubble's popping. The rally's losing steam. Let's go short the market. Have very quickly pulled their reins back in, sucked their, losses up, licked their wounds, and hoped for the next sell-off, right? Well, the collar trade allows me to participate bullishly, but yet be very quick in reaction if the market decides to change bearish, to hedge my profits and to hedge my risk. Now, again, most people are going to approach the collar trade as taught in many standard textbooks. I approach it completely differently. I shouldn't say completely different. I'm using the same three instruments, but I don't put them in the same places as you've probably learned from other places who you may have watched a YouTube channel on how to structure a collar trade. Let me show you how I do it. I'm going to place my long put at the money or near the money with a minimum of 45 days of time, probably more like 60. Now again, remember what a put does. It gives me the right to sell my equity at a strike price within a certain time frame. My call option is then sold to pay for the protective put. That's the main purpose. I don't want this put option to be a cost out of my pocket. So I'm going to sell a call option. I'm going to use the credit to offset the premium. I also want to make sure that it's at a higher strike than what my cost basis of my stock is. So in other words, if my equity position has $100 in value, sorry, I'm venturing out and doing some brave new things, Don. I'm drawing on my slides. And I feel like the market is about ready to sell off. I might buy $100 long put and maybe sell 105. Sorry, like I said, it's venturing out new things. My skills are not that great just yet. I might sell a 105 long or short call to pay for it. Now, I'm probably not going to be able to pull that off using same strike or same expiration options. I may have to, buy a 60-day put and sell a 120-day call. Now, that's okay if I have a differential in time. I know a lot of times people say, well, what about that 60 days between your expiration of your put and your short call? Well, don't worry about that. And why I say that is that's thinking of the trade statically. Don't think statically in the market. Think dynamically. And what I mean by that is that although I might put this on to begin with, as the market moves, I'm going to move with it. And let me walk you through an example. Let's say I structured this trade, and we'll say I spent, what's an average price? We'll say maybe I spent $4 on this this little put option here. And then I sold the call option. And again, this one's 60 days. And then I sold the call option, we'll say for 120 days. And I sold this call option for $5. Now, I might not be very generous in saying that it's only bringing in 5, but we'll just say we brought in 5. And now we make an assumption that the stock drops to 80. Sorry. Again, skills are not great, but I'm learning new things. What's my put worth, folks? I bought the stock at 100. I have a 100 strike put that gives me the right to sell the stock at 100, and the stock's at 80. Well, the put's worth at least $20, right? Might be worth a little bit more, but we'll take it all the way to expiration. How about the short call? What's it worth? So 105 strike call. Now, it still might have 60 or 90 days of time left in it. So it's not going to be worth 0, but it's also a 105 call, and the stock has dropped to $80. I'm going to be kind here and say it's still worth $1. It may only be worth a nickel. So let's walk through the math then. Well, what's happened here? Well, I've lost $20 in my equity that I bought it, that my cost base is 100. It's now worth 80. My put option that I bought for $4 is now worth $20. So I've got a $16 profit in my put, and my call option that I sold for $5 is now worth $1. So I've made $16 of profit in my put. I've made $4 of profit in my call option. I've made a total of $20 of profit in my options, and I've lost $20 in my equity. Now, I haven't made any money, have I? But the key thing is I haven't lost any money. That's the point with this trade. Is at times the market may get chaotic, and I may feel like I need to collar my stocks. I'm not going to do it at all times. I don't want this in a bullish market. In the bullish market, I'm going to use just the stock position. In fact, let me walk through kind of my rules that I use. Here's an example of a relatively recent one. And again, here's what I might look at. How do I structure it? This is a, stock's at 22.41. I would buy, you know, a 38-day put for 98 cents. I'm going to sell a 101-day strike at the 24 strike for $1.38. And that's how I'd structure my trade. My cost basis, here's the way to calculate it. You have 22.41 where I bought the stock, plus 98 cents for the cost of the put, minus $1.38. My cost basis in the shares is $22. With a strike 22 put, I'm actually hedged. I have theoretically no risk while this put's in place, regardless, or I have a penny of risk plus my commissions, regardless of how far down this stock may drop. This is the idea of the collar. There are times when you have signals that may trigger that say, hey, it's time to get bearish, it's time to get cautious. I don't know for how long. I'm not really a short type of guy. I'd rather be bullish and do my homework to put myself in bullish positions and use the collar trade to hedge. Okay, let me walk through my rules for you, and then I'll walk through a case study as well. My rules on adjusting this collar trade. First rule is a pretty obvious one. When the stock is bullish, let it go. Leave it alone. Don't sell calls against it. Don't buy puts for it. You don't need it. When the stock is running and moving higher, let the stock move higher. That's where you're going to get your biggest bang for your buck when you're playing with your equity positions. Now, that doesn't mean I don't like covered calls. I do. I use them all the time. But there's a certain time to sell it. For me, my rules are right here. I'm going to add a covered call on a couple of different occasions. First one is if the RSI has been above 70 and comes back below 70, that's an indication to me from a technical indicator that the stock's bullish movement has slowed down. It's a perfect time to sell a call. Now, my call is going to be at the money and front month. In fact, preferably if they're available, I'm going to use weeklies if they're available. Not all stocks have them. Most of them do. Most of your active traded stocks do now. But for those that don't, I might just sell a monthly. Now, another time when I might sell a call is if the stock is, because not all stocks get their RSI above 70, right? I might decide, you know what, this is a stock that, 3 or 4 days, RSI has been hovering around 50, sell a call. Again, it's an indication that the stock is going sideways. Now, covered bullish, we've covered sideways. Well, what about bearish? Well, bearish, we kind of already walked through the structure of the trade, but here's my signals that I use for a bearish turn. Some of you might use your own custom indicator that you've created at TradeStation to define what you think is a bearish trend change signal. Some of you might follow somebody else's tool. I say use whatever tool you feel comfortable with, helping you make decisions on trend changes. I particularly like a combination of 3 different technical indicators. I look at the 5 and 20 exponential moving average, I look at the RSI, and I look at the MACD. Now, when I have all 3 of those give me sell signals simultaneously, that's a very valid sell signal that says turn this stock into a collar trade. Now, again, my collar, I'm going to buy my puts at 60 days at a time, and then I'm going to sell my call 3 to 6 months out, enough to pay for the long put. These are general rules of thumb that I specifically use. You asked the question, why do you pick 45 days? A 15-day might be better, so your theta decay is quicker, especially for the bull put. Absolutely. I'm giving you a general ballpark number right now, and this is how we teach you conceptually inside of OptionsANIMal as well, is teach you some general rules, and then you need to figure out how to tweak those to best fit what your trading strategy works. This is what works for me and what I've found success with. Now, the art part of this collar trade and what you learn inside of our education on the adjustment process is when do I pull back out of it? When does this collar trade get reverted out of? And for me, there's 2 different times. The first one is, maybe I've written it second here, but the easiest one to explain anyway, is the long puts run out of time. I'm at expiration with my 60-day put. Stock has been dropping, dropping, dropping. Remember the example we looked at? It went from 100 down to 80. It's still dropping, but I'm running out of time with my put. Well, if that's the case, sell the put, take the profit from that put, buy back the short call, take the profit from that short call, take that profit, essentially lower your cost basis in the stock down to 80, and now recollar. Buy a new put, now with 60 days more time, and sell a new call with 120 days of time to accomplish the same thing that we talked about before. But now, again, now I don't have to do it up at 100. Now I do it down at 80 because that's my new cost basis. So that's the first time. The second time when you should revert out of a collar really comes down to being able to determine when a stock has found support. This is a pretty key, this is a pretty, I would say, artful way of being able to determine when a stock has found support. This is the art of this trade. There is no exact technical indicator, in my opinion, that determines where support is, but that doesn't mean you can't get good at defining support levels. Ultimately, what a support level represents, when you're looking at a chart, a lot of people will point to, to their charts and say, well, it's the, 200-day moving average, or it's the, two standard deviations, or it's the Fibonacci retracement. I know there's a lot of different tools that you can use to try to determine support levels. Ultimately, the best way to determine a support level, what I have found, is to trade the same stocks, same group of stocks, over and over and over again. Because what you're doing is you're getting to know the institutions that trade those stocks. Because it has nothing to do with a 200-day moving average that causes a stock to bounce. It causes a stock bounces because David Einhorn or Carl Icahn or Warren Buffett or George Soros decides, hey, you know what, Apple at that level is attractive again, I'm buying. And they jump in and start buying shares and it moves the thing higher. That's what causes support, are big institutions. And as you trade the same stocks over and over and over again, you get to know those institutional traders that actually truly do represent support and resistance. So that's why I say don't try to trade the whole market. Find a handful of group of stocks, follow them regularly, and trade them over and over and over again. Because as you do, you start to become familiar with the behaviors of, David Tepper and Carl Icahn, as I mentioned. Okay. The last two rules of this adjustment have to do with earnings. Earnings is the one event that can cause unknown movement. And even if the stock has been bullish in anticipation of an earnings event, you should always hedge yourself. The way I hedge, if I'm going bullish into earnings are approaching, I wait about a week before the event and I go buy a put right alongside my stock position. I usually have anywhere from a 30-day time frame, maybe as short as even just a 2-week time frame, to get myself through that earnings event and give myself basically a form of fire insurance, just in case. I hope I lose every single dime that I spent on that put. Why? Because that means the stock beat earnings and it's up afterwards. That's what I want because I'm bullish. Now, in case I'm wrong, I still want that hedge. Now, the other situation is, well, what if it's bearish going into earnings? Well, in that case, I want to close out my collar trade. Basically, by closing out the short call position. I want to go through earnings with an unlimited upside. And the reason for that is I feel those are sometimes the biggest moments when stocks can come out and have big gap up reversals. Now, some of you may be looking at this and going, well, you're bullishly exposed then going into earnings every quarter. And the answer to that is yes, I am bullishly exposed. Now, I'm not 100% exposed, right? I still have some insurance, but I do have some risk. If I've got the stock at $100 going into earnings and I buy a $100 put with only 2 weeks of time and I go spend $5 or $6 on that put and the stock misses earnings and goes from 100 down to 90, well, I'm only going to make a little bit of money. I'm only going to make about $5. I'm not going to make the full 10 because I don't have a perfect hedge. I'm okay with that with earnings. Why? Because I'm bullish on these stocks. I'm bullishly biased to begin with because they're stocks I believe in. Now, soon you asked, how do you know if your stock is bearish or bullish into earnings? What I mean by that is the trend that the stock is going, that it's trending in prior to the event. So you're just watching the stock, right? If the stock is moving up in anticipation of earnings, then it's bullish into earnings. If it's going bearish into earnings, well, I'm going to keep that collar trade on until right before the earnings event. Let me walk you through a case study here. I'm going to show you a couple of back-to-back years on Apple specifically. And the reason why I chose Apple is it's a good example of two completely different years, even though the buy and hold guy experienced kind of the same thing. The 2 years here, 2011 and 2012. Now, 2011 was essentially straight up. I know that doesn't look a lot like straight up. This is pre-7-for-1 stock split. That actually represents about an $80 move. And almost every quarter, Apple came out and beat earnings and rallied afterwards. Now, 2012 was different. We had big bullish movement with the release of iPhone 3. Then Steve Jobs got sick. Then we had more excitement about the iPhone. And then the Samsung Galaxy got released. And this actually was quite a painful year for Apple shareholders because the stock had peaked at $700 a share in October. And then over the next 6 months slid from $700 to like $380 a share, where it dropped out in like March of the following year. Got cut nearly in half over really nothing. Again, the whole paranoia was that Samsung has released a product that's going to kill the iPhone. And it didn't happen, but it definitely caused volatility in the stock. Let me show you how, following these rules, you would have traded. Now, you don't have to, I'm not going to go through each one of these in detail, but this is essentially how often you would trade following those 5 rules that I just wrote out. Now, notice it's not every day. Sometimes it's every day, every other day. Sometimes you don't trade for a couple weeks, depending on what the stock is doing. You're just sitting there watching, following those 5 rules. Oops, sorry. So there's your total number of trades you do throughout a year in 2011. Here's the results. Now, first I'll look at how would the buy and hold guy have done. Now, Apple on January 1st, 2011 was trading at 325.71. 1 year later, stock was at 405.58. About an $80 return, or 25% return on investment. Easy buy and hold, right? January 1, 2011, now with the collar trade, sorry, that formatting doesn't fit exactly right here in Obnovia. So the following year, same type of performance, right? But now I've got some option trades that I executed. In fact, the option trades actually ended up losing me about $34 a share. I made a little bit of money back re-entering some covered calls that got assigned. Net on the year was a total profit of $53 a share, or a 16% return on investment. I know some of you are saying, why are you showing me this trade again? It didn't do as well. You're right, it did not do as well. And anytime you compare a collar trade type of strategy with just being straight long stock that went straight bullish, you're going to get beat. That's what I think a lot of people are experiencing right now in their own trading. They're looking at some of these option trading strategies they've been doing, like bull puts and long calls and covered calls, and just buying stock, and they're seeing how well they're doing in their portfolio, and they're outperforming some hedge funds who are hedging throughout risky times, and they're thinking, hey, I'm better than the market. But again, don't mistake that bullish market for brains, because the difference between these two is this portfolio was completely unhedged. This one slept at night through earnings. How much are you willing to give for that comfort? Well, it's not always just about comfort. Let me show you what volatility also adds. Let me throw one more year in there. Now, we'll still start in January 1, 2011, but now we'll go to December 31, 2012. Now we're looking at a 2-year period. 2 years later, Apple's trading at $5.32. They also started paying a dividend that year of $5.30 a share, so you got to calculate on that in there. A total profit of $212 a share, or a total ROI of 63%, annualized at about 32%. The collar trade still got the dividend. Now the additional volatility added over $100 of profit with option trades. Actually lost a little bit of money chasing covered calls that stocks ran away from me a little bit. Total profit on the year, on the 2-year period, $313, 96% return on investment, annualized 48. And this is the portfolio that was hedged. That's what volatility can do. Now, let me take it one step further. You guys can understand why I do this, right? Why this trade is so attractive. Let me show you what it would have done, putting it into some diversification. We'll put 25% of the portfolio into Apple, 25 in Cat, 25 in Lululemon, 25 in Goldman Sachs. I passed my Jim Cramer, am I diversified? All right, 200 shares of Apple. This is January 1st, 2011, 325.71. 900 shares of Lululemon at 69.39. 400 shares of Goldman Sachs at 170.55. 600 shares of Caterpillar at 94.38. Total portfolio $250,000. Okay, 1 year later, 15,974 is the buy and hold. Lululemon had an even better year. They had a 2-for-1 stock split. Look, there's now 1,800 shares. A lot of volatility that year. $22,000 profit. Goldman Sachs, $31,000 loss. Stock got cut nearly in half. And Caterpillar didn't do much, mostly trended sideways. Net return at the end of the year, about $6,500, or about 2.5%. How many times has your portfolio done this? You had 2 great performers, one that fell asleep all year and one that ruined the party for everybody. Let me show you the collar trade. Well, wait, first let me compare it against the S&P. You still beat the S&P, right? S&P was only up 1% that year. All right, let me show you the collar trade. Now, as mentioned, the collar actually lost money in Apple in comparison, so it was only a $10,000 profit. Lululemon, however, had a huge profit because of the volatility. This next one's my favorite. Goldman Sachs, although it didn't turn it positive, it brought in almost $20,000 of profit in options to offset the $31,000 loss in the stock, to make it so that it was only a $10,000 loss. That's the beauty of the collar trade, is it keeps losses at a minimum. So it allows your winners to then actually turn your portfolio into a profit instead of ruining the party for everybody. And again, remember, this is the side of the portfolio that was hedged. This is the core of the strategy I use in the hedge fund that I manage. It's the core of the strategy that I use inside of my own personal trading. It doesn't mean it's the only type of trading I like to do. I love doing iron condors. I love doing credit spreads and calendars. But when I make profit in my option trades, when I find opportunity, I use that profit to dump it into equity positions that I then use this collar trade to hedge risk. Now, one more step. Okay, that's great. That's 2011, 2012. How does this strategy work in chaos? Well, let me show you 2008. Now, I had to swap out Lululemon for Costco because Lulu was not public yet. But I just picked another popular retailer to throw in there. So 300 shares of Apple at $199.33. 900 shares of Costco at $69.63, 300 shares of Goldman Sachs at $214.80, and 900 shares of Caterpillar at $72.56. Again, same portfolio value, about $252,000 on January 1, 2008. Here's 1 year later. That same portfolio, Apple down $34,000, Costco down $15,000, Goldman Sachs down almost $39,000, and Caterpillar down almost $24,000. Total loss, had you bought and hold, $111,000, or about 44% in 2008. Don't kid yourself, folks. Another 2008 is coming. I don't know when. We're still in the inflation part of this bubble, in my opinion. We may keep going up for another 6 months. We may keep going up for another 2 years. I don't think it can go much beyond that because we have such a long bullish market that's already in the books. We're already approaching one of the longest bullish markets in history without a major correction from the bottoms that we hit in 2009. So don't kid yourself if you don't think another type of this correction isn't coming along. If you don't understand how to trade it, you need to learn it. Let me show you how it did. Apple made money, Costco made money, Goldman Sachs made money, and so did Caterpillar, using those simple 5 rules. Total portfolio value actually went up about 11%. In one of the worst bearish markets that we have experienced in the last 75 years. Every person I know who understood this specific collar trade, who were trading the markets in 2008, made money. They were positive in 2000. And it's not because they were short the market. It's not like we were all a bunch of guys like the movie The Big Short that saw the writing on the wall of the housing market collapsing and went and shorted, credit default swaps and, shorted the insurers and shorted AIG and all. That wasn't the case. I was in stocks just like the ones I showed you. I was in Apple. I was in Research in Motion. I was in Disney. I was in stocks that got punished during those years. But I used the collar trade to hedge risk, and it allowed me to maintain my profitability, maintain my capital. So how do I fix that bull put that we started with? How do I avoid these? This is actually a chart from today. This is Casey General Stores. Big gap down. If you had done a bull put based off of this last support level, right here at about 114, 113, 114, and then had a big gap down where it's trading at 106 now. If you had a stop at 110 or at 111 and it opened at 106, you don't get filled at 110. You get filled where the market is trading. That's even further exemplified when you go to the options market if you're trying to put stops in place. A stop loss is a limit order. It does not have to be filled until it triggers, and then it triggers to a market order. And if it triggers to a market order, then you get filled at wherever the market is trading. So don't confuse a stop. And like I say, don't get me wrong, stop losses are better than nothing, but stops can be blown right through. So for me, how do I fix it? Well, again, I'm going to show you some of the stuff that we teach inside of our education. This is actually pulled from one of our classes called Adjusting the Bull Put. And it's a flow chart, it's a thought process of, okay, well, how do I structure it? And then what do I do based on the different trends? So here's your bull put. You've got a short put at a higher strike than your long put, same expiration series. I monitor it. Well, if it's bullish, then that's going to be my primary exit, right? The primary exit will be to allow the options to expire worthless or close the trade early to capture partial profits. I need to define that exit up front. Well, what if it goes sideways? Well, again, where's it at? Is the short put in the money? You might think, well, if it's gone sideways, how's it in the money? Well, maybe you structured it in the money to begin with. Or maybe it's just gone slightly down. So you need to define, first of all, is the short put in the money? If it is in the money, or excuse me, if it's not in the money, well, then that's your primary exit. You allow the options to expire worthless. Might be to close the trade early to capture some profits. If it is in the money, well, then that's going to trigger then my secondary exit, which might be to close the trade. If I'm profitable, it might be to roll the options down and out, give yourself more time, redefine the exit points. It might be to adjust to a collar trade by allowing the put to get assigned, taking possession of the shares, and then using the collar trade example that I just went through with you. Well, okay, what if it's bearish then? Because I have to look at, okay, I looked at bullish, I looked at stagnant, now what if it's bearish? Well, now you have to ask a couple other questions. Okay, well, how bearish is it? If it's really bearish, then I might adjust it to some type of ratio spread by adding additional long puts. It may be still that I want to adjust it to a collar trade by allowing the short put to get assigned. And then redefine my exits. This thought process really is the idea behind adjustments. And it is, what is the trend? And can I do anything from either adding positions to it to repair it or adjust it to make what is now a new trend? And I can promise you, if you can learn this process, if you can wrap your mind around this concept, you're going to approach the market differently. I don't approach the market with any level of fear. And the reason for that is because of this concept. Now, these trades for us, and I know we've TradeStations, these are disclaimed as theoretical trades. For us, the way we teach this process inside of our education is we show by example. Every week we send out a trade called an animal trade. Now, these animal trades are all trades by the instructors inside of our curriculum that for us are real cash trades. Now, they're not investment advice. We don't tell our students to go follow them other than in their paper trading accounts so that they can learn and internalize this process. As you're going through, what we then do, so we walk through, we show you, here's why I'm in the trade, here's the setup, here's the structure, here's my primary exit, here's my secondary exits if I'm wrong, and then boom, we place and actually show you our trade confirmation, because for us, these are real trades. Now, then time starts to tick by, right? And either the trades close or, I shouldn't say that, either the stock goes bullish, bearish, or sideways. And then based on the trend, we hit either our primary exit or our secondary exit. And when we hit a trigger, we make an update and we send out a text alert. We send out email notifications of, hey, this trade what we just did on Apple, it triggered an adjustment. I'm changing the trade. And then we show you the details of what it is we do inside of our website. And what I have found is, as we have sent these trades out over time, that we consistently win. Now, that doesn't mean we don't have losers from time to time. We've sent out a total of 385 trades. Of the 385, 11 of them are still open, 36 have closed for loss, and 338 have closed for wins. The average duration is about 61 days. Now, they're not all that long. Obviously, this is average for the 385 trades. The average return per trade is 16%. This does include the 36 losers. What that equates to is that we win most of the time. 9 out of 10 times we're closing trades for losses. That would be bad. Wouldn't be in the game very long if that was the case. 9 out of 10 times we're closing trades for winners. And the key thing is that we're also using this adjustment process so that the 36 losers that we did have, the 1 out of 10, doesn't wipe out the gains from the previous 9. Because I'm sure many of you who are trading, things like high probability iron condors, which are a great trade, by the way, love them. We have a whole system developed on doing those on the futures market. But that doesn't mean that, some people's experience with high probability iron condors is they win 9 times out of 10, but their one loser wipes out the 9 winners because they don't have an adjustment process. That's what we do. Is again, these are our net results. So how do we do it? Well, again, we learn. We all learn at different rates. If you want to find out information about how we learn and what we do, visit our website. Come, call into our office, and you can speak to someone. They'll give you a one-on-one consultation of how this process can be implemented in your trading. Our number is, and I'll type it down here in the chat box as well. It's 888-297-9165, or you can go visit us at OptionsANIMal.com to find out a little bit more about what we do. Folks, it's a great bullish market. I hope you're all making money and taking advantage of it. This bull will not last forever. And if you haven't figured out how to at least hedge yourself in the upcoming bearish trend, you need to figure it out. And there's nobody in the industry that teaches you better than we do. We're the only accredited learning institution out there. So that if you're looking for college credit and want to use it as a tax write-off, that's what we've done. We're the only accredited learning institution in the education space. So thanks for spending the time with me today. Don, thanks for having us. Love our partner of TradeStation, and look forward to the next event and next opportunity. Thanks, Don. Thanks everyone for this phone call, 888-297-9165. Thanks everybody.
Thank you, Greg Jensen, for coming to TradeStation today for our for the webinar. We really do appreciate your time, and it was great. All of your comments were well taken, aimed at protecting customers' capital, our trading gains, trying to hold on to our trading gains, trying to adjust our positions so that we make profits or break even on losing trades that start losing. Our event today is part of a theme that we're trying to follow through the summer with customer webinars that are aimed at this idea of repairing trades and protecting gains. So we really want to welcome you to take a look at our schedule. I posted it in the chat panel, and review things on our website that can be useful to you. OptionsANIMal are a great partner with us, and Greg Jensen is one of the best educators that we know. So we're very happy to have him today. We hope that you are very happy with his presentation. And certainly, if OptionsANIMal can be of use to you in furthering your own trading expertise, please give them a call or drop them an email to acquire their services. So, having said that, we'll be back tomorrow first thing in the morning, a half hour before the market opens, with Ben McDowell in our morning market briefing. So let's have a great day, great night, and rest up and trade well tomorrow. Thanks very much, everybody.